Welcome to the January 2026 financial summary video. In this video, I have briefly summarized and compiled the key financial developments of January, based on my own research and insights gathered from several reliable news sources. I recommend watching or listening to this video in the background while doing other tasks, as it is designed more for an easy and enjoyable listening experience. But of course, the choice is entirely yours. January 2026, Fed independence, crisis, and the great market rotation. This month brought us something extraordinary: a constitutional crisis at the Federal Reserve, unprecedented tariff announcements, and one of the most significant sector rotations in over a decade. Let's dive into what made January 2026 a month for the history books. Market performance, the great rotation. January 2026 ended with modest gains. The S&P 500 rose 1.5% to around 6,940, while the Nasdaq gained 1.5% to finish near 23,515. But these numbers mask the real story: an extraordinary shift in market leadership. Small caps surge. The Russell 2000 small cap index surged over 8%, dramatically outperforming large caps for 11 consecutive trading sessions, the longest streak since June 2008. This represents a monumental shift after years of mega-cap tech dominance. The Magnificent Seven stumble. The Magnificent Seven tech giants, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, had a rough month. 5 posted negative returns and ranked among the S&P 500's worst performers. Tesla particularly struggled after missing delivery expectations. Sector performance. Energy, materials, and industrials led with gains near 6%. Financials performed well, particularly investment banks like Goldman Sachs and Morgan Stanley on deal-making optimism. Healthcare showed strength, with Novo Nordisk surging 18% on strong obesity drug sales. Technology and semiconductors were clear laggards. This rotation is healthy. When gains broaden across sectors rather than concentrating in a few stocks, it signals a more sustainable market. The Federal Reserve crisis, independence under attack. January's biggest bombshell came on January 10th, when the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening criminal indictment of Chair Jerome Powell over testimony regarding the Fed's headquarters renovation. Powell's unprecedented response. On January 11th, Powell released a rare video statement. No one is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. He then made a stunning accusation. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. Powell publicly stated he believed the investigation was politically motivated, retaliation for not cutting rates as Trump demanded. The pressure campaign. This culminated a year-long campaign where Trump called Fed officials boneheads, and Powell is having no personality, no high intelligence, no nothing. In December 2025, Trump threatened a suit against Powell for incompetence. Market and political fallout. Markets reacted immediately. Stocks fell, the dollar dropped, bond yields rose, and gold surged. Surprisingly, the response was bipartisan. Republican Senator Tom Tillis vowed to block any Trump nominee until this legal matter is fully resolved. J.P. Morgan's CEO Jamie Dimon emphasized, "Everyone we know believes in Fed independence. Anything that chips away at that will raise inflation expectations and increase rates over time." Why this matters. Fed independence isn't optional, it's essential for economic stability. When central banks face political pressure, inflation expectations rise because markets fear decisions will be made for short-term political gain rather than long-term economic health. Powell's term as chair expires in May 2026, but his board position doesn't expire until January 2028, meaning he could remain influential even if replaced as chair. Trump's tariff blitz. The Iran tariffs. On January 13th, Trump announced via Truth Social that any country doing business with the Islamic Republic of Iran will pay a tariff of 25%. This came amid massive anti-government protests in Iran. The implications are enormous. Iran's major trading partners include China, buying 80% of Iran's oil, India, Turkey, UAE, and Iraq. For China, this means a minimum 45% total tariff rate. China's foreign ministry condemned the move. There are no winners in a tariff war, and China will firmly safeguard its legitimate rights and interests. Greenland tariffs. Trump also announced a 10% tariff on 8 European countries until the U.S. acquires Greenland, triggering protests in Nuuk. Markets have become somewhat desensitized to tariff threats, having learned many are negotiating tactics. However, the cumulative effect continues creating global trading uncertainty. Gold reaches stratospheric heights. Gold soared to approximately $4,600 per ounce in January 2026, a staggering 70% gain compared to 1 year ago. Driving forces. Several factors pushed gold to records. Geopolitical uncertainty from Iran protests, potential military intervention, and global instability. Fed independence concerns driving inflation worries. Central bank buying as nations reduce dollar dependence. Tariff uncertainty creating economic instability. The message is clear. Investors are hedging against multiple risks. The AI sector, TSMC, provides reassurance. Taiwan Semiconductor Manufacturing Company reported stellar Q4 results and announced capital spending of $52 to $56 billion for 2026, signaling confidence in continued AI infrastructure demand. The stock jumped 4%, Nvidia rose 2%, and the semiconductor sector rallied. This was crucial after a weak week for tech stocks, providing evidence that AI build-out remains robust. RBC Capital Markets initiated Nvidia coverage with a $240 target, citing attractive valuation and expectations for strong AI spending through at least 2028. Earnings season. Mixed signals. Banking sector split. Retail banking giants disappointed. JP Morgan fell 4.2% despite beating earnings as investment banking fees missed. Citigroup, Bank of America, and Wells Fargo declined despite solid results. Investment banks thrived. Goldman Sachs and Morgan Stanley rallied on M&A and IPO optimism for 2026. Other notable movers. Boeing emerged as the Dow's best performer, up over 12%. Caterpillar and Sherwin-Williams gained nearly 12% and 10% on infrastructure optimism. Salesforce and Visa led decliners, each down over 6%. Market outlook. Analysts remain constructive despite the drama. The S&P 500 is expected to post 12 to 15% earnings growth in 2026. Year-end targets. Bank of America expects 7,100, 3.7% gain. Deutsche Bank targets 8,000, 17% gain, and Ed Yardeni forecasts 7,700, 12.5% upside. The January barometer. Historically, when January is positive, the S&P 500 averages 17% for the year. With January up 1.5%, this suggests a positive 2026, though this is statistical curiosity, not prediction. Global snapshot. China posted 5% growth for 2024, with housing prices stabilizing for the first time in 18 months. European markets remained subdued. Cryptocurrencies traded sideways after 2025's rally.